Ashwini Agarwal joins us, founder with Demeter Advisors. Ashwini, good morning. Thank you for joining us.
Morning, Nikunj. Thank you for having me.
6 weeks, only 6 weeks. Multiply with number of days and number of hours. It's not a big number, and the world has changed for equity investors. For a market which was staring at a possibility of a breakdown, we have a print of a new all-time high on the bank Nifty and hopefully soon on the Nifty. What has changed, and why it has changed?
So a few things. I'm sure this has been discussed on your show before. But one is that the outlook for interest rates and inflation has dramatically changed in the last couple of months. If you look at the inflation data in the US, you look at inflation data in India, it's all pointing to the fact that RBI's decision to hold was right and giving everyone the confidence that a pause by the Fed is now obviously given. Whether they cut a few months from now or not remains to be seen. So I think that is, first thing that happened. The other thing that happened was that in early March, obviously, there was this banking crisis which was unfolding in the United States and partly in Europe. And that seems to have found some sort of a closure in the sense that while there are still issues out there with the smaller banks, the loss to the aggregate system in terms of market cap involved or in terms of the potential fallout on larger banks, that's quite contained. So I think, where people were worried that, look, is this a repeat of 2008? And are we starting to see a big sell-off? I think now zooming out a little bit, people believe that financials are not significantly at risk, especially the larger ones. And that narrative has sort of solidified over the last 6 weeks or so. So I think those are the two things I would say that have helped significantly. And lastly, the earnings season has been fairly constructive in India. We've seen raw material prices come off, and that's feeding through to higher gross margins across a whole host of manufacturing companies, leading to hopes that as demand kind of kicks in, you will see operating leverage play itself out. So I think, those are, I would say, the three things that have helped.
I look at the market and I say, okay, all-time high, but frankly, I'm surprised that DI cash holding, all-time high, open interest, 30% lower than when the previous high on the bank Nifty was on an aggregate basis. FIs, they may have bought for 13 days on a row, but the number is still a fat negative for the year. So can I say that now is the time when the naysayers will turn believers and everybody is feeling the fear of FOMO?
I don't know. I don't know, Nikunj. It's too early to say. I'll look at the mutual fund inflow numbers for the month of April. I mean, despite a very solid market performance, the net inflow into equity mutual funds for the month of April was roughly one third of what it was in March. So typically, of course, March you see a peak every year, but I think the April numbers surprised me. I thought that with the market finding some legs, you'll probably see at least a 10,000 crore print. The enthusiasm was missing among the domestic investors. Foreign investors, or rather FII flows, if I think about it, it's a very unpredictable number because it's driven by a whole host of factors. What's happening to EM allocations within EM, cross-country flows. Suddenly I'm told, I'm no expert, but I'm told by people who follow other emerging markets that China is again starting to kind of fall out of favor in a relative scheme of things. So that might have helped. So, these are shifting stands. I don't think that, we can take a cue from foreign inflows over the last 15 days and say that over the next 2 months, they'll continue to be buyers. But I'll tell you something. If I look out over the next 18 months, India is probably one of the few countries that's growing at a reasonable pace with a fairly healthy banking and financial system in place. And in a world that is starved of growth, any country that will post growth or companies that will post growth will get bid up. And that is something that we should not oversee. anything that's scarce gets bid up. History has always told us that. So in that context, I think over the next 18 months or so, I would be very constructive on investor interest from overseas into India.
So that's my limited point, Ashwini. I mean, this year's number is negative. I know we've discussed it. I'm repeating myself. But all I'm saying is that with each passing day, the India appeal gets bigger. It's getting better. US equities, well, there is a different problem there. Chinese equities, black box there. So I just get a sense that maybe there is a compulsion which could be at play by global investors for 2023 now.
Nikunj, you could be right, but I have this, eerie feeling that every time we say that, there is no other alternative and we will benefit from the Tina factor, something changes. So I wouldn't say that. I would focus more on how the markets will behave in response to earnings, in response to margins, in response to growth. And that would that still leaves me positive. Don't get me wrong. I'm positive. I'm positive with the 2-year outlook. It's just that whether it is the only game in town or not, only time will tell. I think India will grow, and growth is scarce in the rest of the world. So that will obviously be an attractive proposition for overseas investors. But let's see how it plays out.
The thing, Ashwini, that I wanted to talk about, Janet Yellen yet again reiterating the warning of June 1st US debt default. If that were to happen, what does it mean for US equity markets? And then the kind of ripple effect that it may have on India. I mean, does it make India dearer, or do you think we're all going to fall in the same manner?
You're asking me a question about something that has never happened before. Okay. US debt is AAA rated. It is, beyond comprehension that the US will not honor its debt obligation. So, I cannot imagine what the repercussions might be. And if you see over the last 10 years, there have been several instances where this debt ceiling has been hit, and federal offices have been shut, or various functions of the government have come to a grinding halt till the Congress has gotten together and raises the debt ceiling. So I think it's going to be a repeat of the same. I think a default is out of the question, or at least I cannot comprehend what that will mean. Your second question is a more broader one: that are we immune to a market behavior elsewhere in the world? I don't think so. I think all markets have certain sentiments which are attached to each other, and if the US were to roll over in a big way, or other markets were to go down in a big way for whatever reasons, that does tend to impact sentiment in India as well, both for foreign investors as well as local investors. So I don't think I want to go and make a statement that India is immune to market developments elsewhere in the world. That doesn't happen.
Okay, Ashwini, morning. Wanted to also get in your take then on the overall macro picture, given the fact that we're talking about inflation having peaked out, the bond yields as well slipping. How are you looking at India's macros at the current juncture?
I think the macros are looking very solid. You will get decent growth. I was at a 5.5% real GDP handle for fiscal 24. If you asked me this question about a month and a half ago, now I'm gingerly hoping that we can be at a 6% handle. The inflation data is really encouraging. I don't know when RBI will cut. That's a little bit more difficult question, because it might be influenced by Fed's willingness to hold on for the time being. But I think overall, whether you look at the fiscal situation, you look at the current account deficit, you look at the FX recovery in FX reserves, everything is telling you that India is in a healthy space. If you look at the bank sector results that have come out for the March quarter, and you look at the commentary from the banks, they're all talking about very solid credit growth. Yes, there will be some compression in NIMs for sure, because deposits are not growing that fast. But at the end of the day, growth is important, because that is a indicator of what the underlying economy is doing. So I think that the macro situation in India is looking very good. Obviously, as the year develops, the focus will also move a little bit towards the elections that will happen in the first half of 2024. And, one hopes for stability, but one doesn't know what that might bring. So we'll have to see that play out. Within the economic growth, I think the only question mark is on revival in rural demand, where you have the prospect of an El Nino development later this year, and which might mean less rainfall. A large part of India's agrarian economy is now pretty well served by irrigation, so it is somewhat immune to rain gods compared to how the situation used to be maybe 15, 20 years ago. So I would hope that to be the case. And the government hopefully will spend on infrastructure and other development projects in the run-up to the election. So I'm hoping for some revival in rural demand, but there are very mixed signs of that. So that's the only question mark that I have. On investment-led demand, on urban consumption demand, I see no issues whatsoever.
Actually, so putting all this to paper then, what should be the tactical allocation towards equities? What are the sector overweights and underweights that you would recommend right now?
See, the asset allocation is a function of an individual's age, income, as well as risk-taking, risk tolerance ability. So it's very difficult to give a blanket recommendation that will apply to all your viewers. But I would say that for somebody who's in their late, say mid 40s to mid 50s, the age bracket I am in, I would say 70% equities, 30% fixed income. That's what I would just put out as a number if I had to put it out. But it has to be tempered by risk tolerance. It has to be tempered by other considerations for each individual investor. Within sectors, I think manufacturing is what I'm quite positive about. And within that, autos and pharmaceuticals in particular, because you will see a significant tailwind to margins from normalizing raw material costs. I think it's already visible in the March quarter numbers, but I think as that factor continues to drive earnings over the next year or so, you might see re-rating in these sectors, because these sectors haven't really done as well as defense-related manufacturing has, for example, where I think valuations are starting to become quite stretched. So I think, over the last 1 year, it's been railways and defense-related manufacturing that has helped. I think consumer-oriented manufacturing is where I would be significantly positive. I'm also reasonably constructive on the banks, where I think the commentary has been more about the worry about slowdown in NIMs. And I think a compression in NIMs, not slowdown, compression, a compression in NIMs will be offset by credit growth. That's my take. So overall, I don't see earnings disappointing even for the banks over the next year. And the stocks have not done much post the results, post very, very good results, for example. So I think that would be an area where I would continue to be reasonably constructive.
Okay, what about IT? Because we haven't really touched upon that. There's two sides to it. One, that we're seeing a lot of disruption, and then there's been a lot of innovation as well that has taken place. From a valuation standpoint, putting all of these factors together, what's the stance on IT?
After almost 1.5 years of underperformance, I was looking forward to the March results to frankly, take an overweight stance. But the commentary from the big players has left me a little bit colder. And I think if you look a little bit deeper and see some of the smaller stocks, they've reported good numbers and good traction in business and recovery in margins. So I think, it's becoming almost a tale of two cities, where smaller companies are able to find their niches and do well, and the larger companies are struggling a little bit, both on business visibility as well as margins. I think an additional worry for me in IT is the outlook for the US dollar. US dollar typically does provide a little bit of a tailwind to IT earnings, and I don't think that tailwind is going to be visible for the next 12 months. And this chat GPT, artificial intelligence, could it prove to be the undoing of IT services? I don't know. It's too early to say, but I've been reading various blogs and statements from various people who are kind of doing things with artificial intelligence that have never been done before, which arguably could take away from some of these services business for IT services companies. I don't know how that will play out. I really have no idea, but it's a risk worth keeping an eye on. So if I put all of this together, it still doesn't give me the confidence to go overweight on IT services.
All right. Ashwini, always a pleasure. Thank you for joining us, and
Thank you,
thank you for your
Nikhil. Thank
valuable
you, team.
inputs.